There is a single question that acts as a gatekeeper to virtually all of Warren Buffett's immense fortune. It is a question so simple, so disarmingly straightforward, that most investors, hypnotized by the siren song of complexity, dismiss it as elementary. Yet this question is the ultimate filter, a cognitive razor that separates durable wealth from speculative ruin. Before you risk a single dollar of your hard-earned capital on a stock, a business, or any investment, you must be able to answer it. The question is this: can you explain, in simple language, why you are buying it? Can you articulate the investment thesis on the back of a cocktail napkin clearly enough that a reasonably intelligent person, unfamiliar with the jargon of finance, can understand your reasoning? If the answer is no, the investment is off the table. It doesn't matter if the idea came from a Nobel laureate, a high-flying hedge fund manager, or a Wall Street analyst with a spreadsheet model that stretches to the moon. If you cannot explain it, you do not own the idea owns you. And when the inevitable storm of market volatility arrives, that idea will abandon you to the wolves of fear and panic. This principle isn't just a quaint piece of folksy wisdom from Omaha. It is a weaponized form of intellectual discipline, a deliberate system for avoiding the single greatest destroyer of wealth, ignorance disguised as sophistication. It prevents you from being seduced by convoluted stories, from buying into industries you don't truly understand, and from being swayed by the complex but hollow arguments of the financial priesthood. An inability to explain your thesis simply is not a sign that the investment is too sophisticated. It is a sign that your own understanding is too shallow. And in the world of money, shallow understanding is a synonym for catastrophic loss. By embracing this rule, you undergo a profound financial transformation. You adopt a discipline of fierce intellectual honesty. You are forced to bypass the noise and focus only on the powerful, understandable currents that truly drive business value. This leads to a portfolio of high-conviction holdings, businesses you understand as well as you understand your own profession. It grants you the emotional fortitude to stand firm, even to buy more, when others are selling in a terror-fueled frenzy. You will learn today that the most profitable ideas in the history of capital markets are not the most complex, they are the most devastatingly simple. This is not just a lesson in stock picking, it is a fundamental shift in decision-making, a commitment to clarity in a world that profits from your confusion. It is the first and perhaps final promise you must make to yourself as a serious steward of your own capital. The journey into this world of radical simplicity begins with a foundational concept, the very bedrock upon which Buffett's entire philosophy is built. It's a mental model so powerful that it has allowed him to sidestep some of the biggest financial manias and subsequent collapses of the last century. This concept is the circle of competence. It is the humble admission that you don't need to be an expert on everything. You only need to define the perimeter of what you do know and operate exclusively within that circle. The simplicity of your investment thesis is a direct byproduct of your proximity to the center of your own circle. You can only explain in simple terms that which you understand in profound detail. And the most vivid illustration of this principle in action took place during a time of global euphoria, a period when Buffett's discipline was openly mocked as archaic, and his refusal to participate was seen as a sign that the old master had lost his touch. The time was the late 1990s, the height of the dot-com bubble. The world was changing at lightning speed. A new paradigm, it was said, had emerged. The old rules of valuation, of profits, of tangible assets were declared obsolete. Companies with no revenue, no profits, and often no viable business plan were soaring to valuations in the hundreds of millions, even billions of dollars, seemingly overnight. Names like Pets.com, Webvan, and TheGlobe.com were the darlings of Wall Street. Any company that simply added .com to its name saw its stock price multiply. The zeitgeist was electric, a mixture of technological utopianism and pure, unadulterated greed. And in Omaha, Nebraska, Warren Buffett was doing nothing. He watched as this digital gold rush swept the nation, as talking heads on financial television breathlessly touted the next billion-dollar IPO, and he refused to participate. His company, Berkshire Hathaway, was dramatically underperforming the market. From mid-1998 to early 2000, while the tech-heavy NASDAQ index more than doubled, Berkshire's stock actually fell by nearly half. The pressure was immense, shareholders were restless, the media was relentless. In a now infamous cover story in late 1999, the prestigious financial magazine Barron's ran a headline that captured the sentiment of the entire market. "What's wrong, Warren?" The article questioned whether Buffett, the undisputed king of value investing, had become a relic, an old man unable to grasp the complexities and opportunities of the new technology-driven economy. He was portrayed as a dinosaur, clinging to his investments in boring old-world businesses like Coca-Cola, Gillette, and See's Candies, while the real money was being made in fiber optics, B2B e-commerce platforms, and search engine portals. During a speech at his friend Herb Allen's Sun Valley Conference in 1999, an event attended by the titans of media and technology like Bill Gates and Andy Grove, Buffett laid out his reasoning. He didn't rail against the new technology. He didn't predict a crash with apocalyptic fervor. He said something far more profound and far more personal. He admitted his own ignorance. He explained that he simply could not, with any degree of confidence, project what these dot-com companies would look like in 10 or 20 years. He couldn't determine their durable competitive advantages, if any existed. He couldn't reliably estimate their future cash flows. He looked at a company like Microsoft, run by his close friend Bill Gates, and admitted that while he had no doubt it would be successful, he had no special insight into its long-term competitive position against an army of unseen future rivals. It was, for him, simply too hard. The investment thesis for these companies was a complex narrative woven from technological jargon, dreams of market domination, and financial models based on metrics like eyeballs and click-through rates instead of profits. It was a story he could not retell in his own simple words, therefore it fell outside his circle of competence. His refusal to invest was not a judgment on technology itself, it was an act of intellectual honesty. He knew the boundaries of his own expertise, and he refused to be lured beyond them by the promise of easy money or the fear of looking foolish. He famously said, "The most important thing to do if you find yourself in a hole is to stop digging." For him, investing in dot-com stocks would have been digging in a field where he couldn't see the ground beneath his feet. He stuck to what he knew: insurance, consumer goods, banking. Businesses whose economics he could understand and explain. And then, the bubble burst. Beginning in March of 2000, the NASDAQ began a catastrophic collapse. The high-flying darlings of the new economy came crashing down to earth. Pets.com, which had raised $82 million in its IPO, went bankrupt and liquidated within a year. Webvan, which had a peak market capitalization of over $1.2 billion, burned through its cash and ceased operations. Trillions of dollars in speculative wealth evaporated. The very people who had mocked Buffett as a dinosaur were wiped out, and Berkshire Hathaway, its stock soared. The capital he had preserved by staying within his circle of competence was now deployed to buy wonderful businesses at bargain prices from the wreckage of the crash. His simple rule, his commitment to only investing in what he could clearly understand and explain, had not only saved him from ruin, but had positioned him to profit immensely from the folly of others. This wasn't just a good investment call, it was the vindication of a philosophy. The circle of competence is the ultimate source of simplicity, because it aligns your financial decisions with your life's knowledge. The psychological principle that Buffett masterfully navigates with his circle of competence is one of the most pervasive and dangerous cognitive biases in human decision-making, the Dunning-Kruger effect, amplified by its insidious cousin, the overconfidence bias. The Dunning-Kruger effect, first described by psychologists David Dunning and Justin Kruger in 1999, is a cognitive bias whereby people with low ability at a task overestimate their ability. In essence, the skills required to be good at something are often the very same skills required to recognize how bad you are at it. A novice chess player doesn't just lack the ability to find the best move, they lack the ability to recognize why their chosen move is terrible. They are, in a very real sense, unconsciously incompetent. In the world of investing, this is a recipe for absolute disaster. The average person, after reading a few articles online and watching a handful of financial news segments, can easily fall victim to the Dunning-Kruger effect. They learn the basic jargon, PE ratios, earnings per share, market cap, and mistake this superficial vocabulary for deep understanding. They believe they have moved from novice to expert in a matter of weeks. This illusion of knowledge emboldens them to venture far outside any reasonable circle of competence. They start making bets on complex biotechnology firms, based on a press release about a phase 2 drug trial, or on a semiconductor company based on a vague understanding of Moore's law. They lack the deep, nuanced knowledge of pharmacology or electrical engineering to properly assess the company's prospects, but they are blissfully unaware of the vastness of their own ignorance. The overconfidence bias pours fuel on this fire. This is our natural tendency to be more confident in our own abilities and judgments than is objectively warranted. A famous study asked drivers to rate their own driving skills. Over 80% rated themselves as above average, a statistical impossibility. In investing, this manifests as an investor believing they have a unique insight or a superior ability to predict the future. They buy a stock, it goes up for reasons that are likely pure chance, and they attribute the gain to their own genius. This reinforces their overconfidence and encourages them to take even bigger risks in areas they understand even less. The genius of Warren Buffett's circle of competence is that it acts as a powerful systemic antidote to both of these biases. It is a forced exercise in intellectual humility. By demanding that you define the perimeter of your knowledge, you are forced to confront the vast ocean of your own ignorance. You are explicitly stating, "Here are the topics on which I am qualified to have a strong opinion, and everything else is off limits." This act of definition prevents the Dunning-Kruger effect from taking hold, because you are consciously moving from a state of unconscious incompetence to conscious incompetence about most of the market. You know what you don't know, and you recognize that this is a sign of wisdom, not weakness. Furthermore, the mandate that you must be able to simply explain the investment thesis shatters the illusion of competence. It's easy to feel smart when you're using complex jargon you picked up from an analyst report. It's much harder when you have to explain the core business of a company, how it makes money, why customers choose it over competitors, and why that will continue for 20 years, in plain English. This process forces a level of clarity that exposes any gaps in your understanding. If you find yourself fumbling for words or resorting to buzzwords, it's a blaring signal that you are operating outside your circle. You are not just making an investment, you are being forced to teach the subject, and as any great teacher knows, you cannot simplify a topic until you have mastered it. This cerebral framework is what allowed Buffett to sit calmly through the dot-com mania. His brain wasn't telling him that tech stocks were bad. It was telling him that he was unqualified to have an opinion. The psychological relief of that admission is immense. It frees you from the pressure to participate in every trend, to have a view on every hot stock. Your ego is no longer tied to being right about everything. It is tied to being disciplined within your defined area of expertise. This creates a state of emotional control and calm that is impossible to achieve when you are constantly pretending to understand things you don't. You replace the anxiety of ignorance with the confidence of true knowledge. So how can you, in your own financial life, translate this powerful philosophy into a practical, repeatable process? The blueprint for this is a mental model I call the 3 circles exercise. It is a way to formally map your own circle of competence and build an operational framework around it, ensuring that every investment decision you make passes the simplicity test. This isn't just a theoretical idea. It's a pen and paper exercise, a tangible commitment to intellectual discipline. First, take out a blank sheet of paper. Draw 3 large concentric circles, one inside the other, like a target. These 3 circles will represent the 3 tiers of your knowledge. The innermost circle is your sanctum sanctorum of expertise. Inside this circle, you will write down the industries, businesses, or technologies that you understand with absolute, world-class certainty. This is not about what you've read a book about. This is about what you have lived. The first place to look is your own profession. If you have been a software engineer for 15 years, you likely have a deep, intuitive understanding of the enterprise software business model, the competitive dynamics, the sales cycles, and the technological moats. If you are a doctor, you understand the healthcare system, the incentives of insurance companies, and the business of medical device manufacturers in a way no Wall Street analyst ever could. Write down your career. Next, think about your deep, enduring hobbies and passions. Are you a lifelong obsessive gamer who understands the economics of game studios and distribution platforms? Are you a car enthusiast who can speak for hours about supply chains and brand loyalty in the automotive industry? These areas where you have spent thousands of hours of your own time actively engaged also belong in the inner circle. The key criterion for the inner circle is this. If you were to sit down with the CEO of a company in this field, could you ask intelligent questions and understand the nuances of their answers for at least an hour? If the answer is yes, it belongs here. Be brutally honest. For most people, this inner circle will be very, very small. It might only contain 1 or 2 industries. This is not a weakness. This is its strength. This is your hunting ground. The second, middle circle represents areas of legitimate familiarity. These are subjects you know a fair amount about, perhaps through your work in an adjacent industry or through extensive study, but where you lack the deep practitioner's insight of your inner circle. Maybe you're a banker who has financed a lot of real estate deals. You don't know construction like a developer, but you understand the financing side intimately. That goes in the middle circle. Maybe you're an avid reader of business history and have a solid grasp of the railroad industry or the rise of consumer brands. These topics belong here. The rule for the middle circle is that investments here require extra work. You can consider them, but you must do a significant amount of research to elevate your understanding closer to that of your inner circle before you commit capital. The third, outermost circle represents everything else in the universe. For 99.9% of publicly traded companies, this is where they will live. Artificial intelligence, deep-sea oil drilling, biotechnology, cryptocurrency protocols, French luxury goods. For most of us, these are black boxes. Your rule for this outer circle is absolute and unwavering. You are not allowed to invest here. Ever. It doesn't matter what you hear on the news. It doesn't matter if your brother-in-law made a fortune on it. You treat this circle as if it were radioactive. The very act of writing this down and seeing it on paper has a profound psychological effect. It transforms a vague idea, invest in what you know, into a concrete, operational map for your financial decision-making. Once you have your map, the next step in the blueprint is to apply the simplicity filter to any potential investment that falls within your inner circle. Let's say you are a retail logistics manager, so the business of companies like Costco and Target are in your inner circle. You identify a potential investment. Your task is to write down the investment thesis in 2 sentences, using the language of your profession. For example, I am buying Costco because its membership model creates a powerful psychological moat and immense customer loyalty, which translates into massive, predictable sales volume. This scale gives it enormous bargaining power with suppliers, allowing it to offer low prices that competitors cannot match, generating consistent and growing free cash flow. That is a simple, clear, and powerful investment thesis. It is rooted in a deep understanding of the business model. It requires no complex jargon, no convoluted financial engineering. It is the kind of thesis that allows for robust portfolio management and sound risk management, because you know exactly what to watch for. Is membership renewal still high? Is their purchasing power still intact? Your clarity on the thesis gives you clarity on the key performance indicators. This 3 circles exercise is your personal constitution for investing. It is the framework that forces you to adhere to the principle of simplicity. It protects you from the siren song of the crowd and grounds your decisions in the bedrock of your own genuine knowledge. The vast majority of people, the 99% who consistently underperform the market or lose money over the long run, follow a path that is the polar opposite of the circle of competence. They operate from the outside in, chasing complexity and narratives in a desperate attempt to find the next big thing. This is the path of the 99%, a well-trodden road to financial disappointment paved with hot tips, speculative manias, and a fundamental misunderstanding of what investing truly is. The process for the typical investor begins not with a quiet, introspective assessment of their own knowledge, but with an external stimulus. They hear a stock tip at a cocktail party. They see a charismatic CEO being interviewed on a financial news network. They read a headline about a revolutionary new technology that is going to change the world. The story is exciting, the narrative is compelling, and a powerful psychological force kicks in. The fear of missing out, or FOMO. They see their peers getting rich on stocks they've never heard of, and an intense anxiety builds. They feel a desperate need to get in on the action. Let's trace the journey of an investor mesmerized by a story stock, for instance, a small biotechnology company. The story is incredible. This company is developing a revolutionary new drug that could cure a terrible disease. The CEO, a brilliant scientist, speaks with passion and conviction about their groundbreaking research. The potential market is enormous, worth billions of dollars. The stock has already gone up 200% in the last 6 months, but the online forums are buzzing that it's just getting started. This investor has no background in molecular biology, no understanding of the FDA approval process, and no ability to read a clinical trial report. Their circle of competence might be in accounting or marketing, but this stock exists in the farthest reaches of their outer circle, yet they buy it. Why? Because they are not investing in a business. They are buying a lottery ticket with a good story attached. They have outsourced their thinking to the narrative. Their investment thesis, if they were forced to write one, would be a jumble of borrowed jargon and hopeful platitudes. This company has a disruptive technology in the oncology space with a huge total addressable market, and their lead compound showed promising preliminary data. This sentence sounds intelligent, but it demonstrates zero genuine understanding. It is a script they are repeating, not an analysis they have performed. Now, the second stage of the disaster begins. Because the investor's conviction is not rooted in their own knowledge, it is incredibly fragile. It is entirely dependent on the stock price and the prevailing narrative. As long as the stock is going up, their genius is confirmed. But then, the company announces a slight delay in its clinical trials, or a competitor publishes some positive results. The stock drops 30% in a single day. The 99% investor is now in a state of pure panic. They have no internal anchor of understanding to hold on to. They cannot independently assess whether this news is a minor setback or a fatal blow to the company's prospects. All they see is red on their screen and the evaporation of their money. The narrative has turned against them. The online forums are now filled with fear and anger. Their mind is flooded with doubt. What if this was all a scam? The market must know something I don't. I need to get out before it goes to zero. They sell at a significant loss, crystallizing their mistake. This is the inevitable consequence of straying from your circle of competence. You are a ship without a rudder in a hurricane, tossed about by the waves of market sentiment. The dot-com bubble was a perfect, large-scale example of this phenomenon. Millions of ordinary people, whose competence lay in teaching, plumbing, or running small businesses, poured their life savings into internet companies they couldn't possibly understand. They weren't buying businesses. They were buying ticker symbols attached to a grand story about the future. When the story broke, they had no intellectual framework to fall back on, only terror. And so they sold, transferring their wealth to those, like Buffett, who had remained anchored in the calm waters of their own competence. This path of the 99% is seductive because it promises a shortcut. It suggests that you can get rich without the hard work of learning, without the intellectual humility of admitting what you don't know. It is a fantasy, and like all fantasies, it inevitably collides with the harsh wall of reality. The direct financial connection between strictly adhering to your circle of competence and building substantial wealth is one of the most misunderstood concepts in modern portfolio theory. The prevailing wisdom, taught in business schools and preached by financial advisors, is that diversification is the only free lunch in finance. You should own a little bit of everything: stocks, bonds, international equities, real estate, to reduce risk. For the average person who has no interest in doing the work of an investor, this isn't terrible advice. But for the serious student of wealth creation, it is a recipe for mediocrity. The principle of the circle of competence leads to the exact opposite conclusion. The path to extraordinary returns is through intelligent concentration. When you have a very small, well-defined circle of competence, you are not going to find hundreds of brilliant investment ideas. You are lucky if you find one or two a year. This scarcity naturally leads to a more concentrated portfolio. When you find a wonderful business that you understand inside and out, and it is selling at a fair price, the logical thing to do is not to buy a tiny position. It is to bet heavily. This is precisely what Buffett did in 1963 with American Express, when he invested 40% of his partnership's capital into that single idea. It is what he did in 1988 with Coca-Cola, investing over $1 billion, a massive position for Berkshire at the time. This looks like extreme risk to the outside world. But from inside the circle of competence, it is the safest thing you can do. What is true risk? Is it putting a large portion of your capital into a business whose economics you understand with absolute clarity? Or is it scattering your capital across 50 different companies you barely understand, in a blind hope that the winners will outweigh the losers? Buffett calls the latter diversification. It is a confession that you don't know what you are doing, so you own a bit of everything. True risk management is not about how many stocks you own. It is about the gap between your perceived knowledge and your actual knowledge. A 30-stock portfolio of companies outside your circle of competence is infinitely riskier than a 5-stock portfolio of companies squarely within it. Let's quantify the financial impact. Imagine two investors, both starting with $100,000. Investor A follows the path of the 99%. They build a widely diversified portfolio of 50 stocks, chasing trends and hot sectors they don't understand. Their portfolio roughly mirrors the market. Over 30 years, they achieve the market average return of, let's say, 8% per year. After 30 years, their initial $100,000 will have grown to approximately $1,006,000. This is a good outcome, a testament to the power of basic compounding. Now consider investor B, who has adopted the circle of competence discipline. They are a dental surgeon, and they have spent a decade defining their circle. It consists of two areas: dental supply companies and medical office real estate investment trusts. Over that same 30-year period, because of their deep industry knowledge, they are able to identify just 10 truly exceptional investments. Because their conviction is so high, they invest heavily in each one. They don't hit a home run every time, but their deep understanding allows them to avoid catastrophic mistakes and achieve an average annual return of 12%, a mere 4 percentage points higher than investor A. It doesn't seem like a huge difference, but the power of compounding is not linear. After 30 years, investor B's initial $100,000, compounding at 12% per year, will have grown to approximately $2,996,000. That is nearly 3 times the result of investor A. That 4-point edge, derived directly from the discipline of staying within a circle of competence, created an additional $2 million of wealth. This is the financial power of simplicity and focus. It transforms investing from a game of chance into a game of skill played on your home turf. It allows you to make large, informed bets that, over a lifetime, produce the kind of results that are mathematically impossible for the diversified, unfocused investor to achieve. Your financial education is incomplete until you understand that your personal knowledge, when honed and applied with discipline, is the most powerful financial asset you will ever possess. Once an idea has passed the rigorous test of the circle of competence, the next step in Buffett's system is to codify that understanding. It's not enough to simply feel that you understand a business. You must be able to articulate that understanding with crystalline clarity. This is the art of the one-page memo, the discipline of distilling a complex analysis into a simple, powerful investment thesis. The goal is to create a document so clear and concise that it can guide your decision-making and serve as an anchor in any future market storm. There is no better story to illustrate this principle of codified clarity than one of the most formative acquisitions in Berkshire Hathaway's history, a deal that fundamentally changed how both Buffett and his partner Charlie Munger thought about business. The year was 1972, and they were presented with an opportunity to buy a boxed chocolate company based in California called See's Candies. On the surface, it didn't look like a typical Buffett investment. At the time, Buffett was still very much in the cigar butt phase of his career, buying mediocre businesses at dirt-cheap prices. See's was anything but cheap. The sellers, the See family, were asking for $25 million. The company had only about $8 million in tangible assets. This meant Buffett would have to pay a $17 million premium for goodwill, an intangible concept that, at the time, he was deeply skeptical of. His initial reaction was to walk away. The price was simply too high based on his quantitative, asset-focused framework. But Charlie Munger saw something deeper. He pushed Buffett to look beyond the numbers on the balance sheet and to understand the simple yet profoundly powerful business reality of See's Candies. So they did the work. They didn't build a complex discounted cash flow model with dozens of variables. They focused on codifying the simple thesis. The memo they might have written to themselves would have looked something like this. Thesis: See's Candies is a phenomenal business because it has a powerful, enduring brand that creates immense pricing power. The company is a beloved institution in California. For decades, customers have associated See's chocolates with quality, nostalgia, and special occasions. When a man wants to apologize to his wife, he buys a box of See's. For Valentine's Day or Christmas, it's a social ritual. This brand loyalty is so strong that customers are not price sensitive. Every year, the company can raise its prices to cover inflation and then some, and the customers don't blink. They happily pay up for the product they know and trust. This pricing power, combined with a business model that requires very little new capital investment, they didn't need to build expensive new factories or fund massive R&D projects, meant that See's was a gusher of cash. It was a simple, beautiful economic machine. That was it. That was the entire thesis. It could be explained in under a minute. It was based on observable reality, on the simple human psychology of brand loyalty. This simple thesis gave them the courage to do something that was, for them, radical. They paid the $25 million, and the results were staggering. In the years that followed, See's Candies sent hundreds of millions, and eventually billions of dollars in cash back to Omaha. That cash, generated from the simple business of selling chocolates, was then used by Buffett to buy other wonderful businesses. The $25 million investment not only returned its own cost many times over, but also funded a significant portion of Berkshire Hathaway's growth for decades. The experience with See's Candies was an epiphany. It taught Buffett and Munger that it was far better to buy a wonderful business at a fair price than a fair business at a wonderful price. And the key to identifying a wonderful business was the ability to distill its competitive advantage into a simple, qualitative thesis. The price was a secondary consideration to the quality of the business itself. The clarity of that one-page memo, that simple paragraph, was the key that unlocked a new and far more powerful phase of their investment careers. It shifted their focus from the complexity of financial statements to the simplicity of durable competitive advantages, a shift that would ultimately be responsible for the majority of their legendary returns. The psychological principle that underpins this need for a simple, written thesis is a powerful learning tool known as the Feynman technique, named after the Nobel Prize-winning physicist Richard Feynman. Feynman was renowned not just for his brilliant contributions to quantum physics, but for his extraordinary ability to explain incredibly complex subjects in simple, intuitive terms. His secret was a specific method he used to test his own understanding. The Feynman technique consists of 4 steps. First, choose a concept you want to understand. Second, pretend you are teaching it to a child. Write it out on a piece of paper, using only simple language, basic analogies, and clear examples. Third, identify any gaps in your explanation. Where did you have to resort to jargon? Where did your explanation become convoluted or confusing? These are the areas where your own understanding is weak. Fourth, go back to the source material and review those weak points until you can explain them in simple terms. Repeat this process until you have a clear, simple, and complete explanation. This technique is, at its core, a tool for enforcing intellectual honesty. It is impossible to hide behind vague notions or sophisticated-sounding buzzwords when you are forced to explain an idea to a 10-year-old. The act of simplification is a harsh and unforgiving mirror that reflects the true depth of your knowledge. When you apply this to investing, it becomes a devastatingly effective filter. An investment thesis that cannot survive the Feynman technique is almost certainly a bad idea. Imagine trying to explain a complex derivative strategy like a collateralized debt obligation, or CDO, to a child. You might start, "Well, you see, you take a lot of different mortgages, and you put them all together in a pool." You would immediately get lost in a sea of jargon. Tranches, credit default swaps, special purpose vehicles. The inability to simplify the concept is a giant red flag, signaling that the underlying reality is a tangled mess of assumptions and dependencies that you do not truly grasp. Now imagine explaining Buffett's investment in Coca-Cola to a child. There's a company that makes a brown, sugary drink that almost everyone in the world knows and likes. Because they like it so much, they are happy to pay a little bit more for it every year. The company sells billions of these drinks every day, and each one makes them a tiny bit of money, which adds up to a giant pile of cash. The child would understand. The thesis is simple because the business is simple. The Feynman technique works because it short-circuits several cognitive biases that lead investors astray. It defeats the illusion of explanatory depth, our tendency to believe we understand a system in far more detail than we actually do. By forcing you to write it out, it exposes the shallowness of your knowledge. It also combats the expert halo effect. We often accept a complex idea from a perceived authority figure without truly understanding it ourselves. The Feynman technique forces you to internalize the idea and make it your own. You cannot simply repeat the expert's words, you must translate them into your own simple language. If you can't, you haven't really learned anything. Creating a simple one-page investment thesis is the financial equivalent of the Feynman technique. It is a declaration that you will not invest your capital based on borrowed conviction or superficial understanding. You are committing to a level of mastery that allows for profound simplification. It is a psychological tool that transforms you from a passive consumer of financial ideas into an active, critical thinker, capable of distinguishing between genuine insight and hollow complexity. How do you put this into practice? How do you move from the abstract idea of a simple thesis to actually creating one? You need a practical blueprint, a framework that you can use every single time you consider an investment. This framework is the 2-sentence thesis. It is a structured format designed to force clarity and brevity, ensuring that you have identified the core pillars of a sound investment. The framework is composed of 2 distinct parts, each forming a sentence. Sentence 1 must answer the question, why will this business be successful? It must identify the specific, durable competitive advantage, or moat, that protects the business from competitors. Sentence 2 must answer the question, why is this a good investment for me right now? It must explain why the market is currently undervaluing that competitive advantage, providing you with a margin of safety. Let's break it down with a fill-in-the-blanks template. Sentence 1. I am buying company X because specific durable competitive advantage, which allows them to specific observable business outcome. The first blank requires you to name the moat. Is it a powerful brand like Nike's? Is it a network effect like Facebook's? Is it a low-cost production advantage like Geico's? You must be specific. Technology is not a moat. A great brand is a start, but a brand synonymous with athletic achievement and aspirational identity is better. The second blank forces you to connect that moat to a real-world business result. Does it allow them to charge higher prices? Does it lock in customers and reduce churn? Does it create a cost advantage? Sentence 2. I believe the market is currently undervaluing this because of specific temporary reason, and I expect this advantage to generate specific, measurable financial outcome over the next time frame. The first blank here is crucial. You must have a theory for why the stock is cheap. Is the market overly focused on short-term headwinds? Is it punishing the entire industry for the sins of a weaker competitor? Is there a temporary, solvable problem that has created fear? It just seems cheap is not a reason. The second blank forces you to quantify your expectation. Are you expecting earnings to grow at a certain rate? Are you expecting the dividend to increase? This turns a vague hope into a measurable hypothesis. The final blank sets a reasonable time horizon for your thesis to play out. Let's apply this blueprint to a real-world example, say a hypothetical investment in Apple, a number of years ago. A novice might say, I'm buying Apple because they make great products and the stock is going up. This is a worthless thesis. It has no analytical depth. Now let's use the two-sentence thesis framework. Sentence 1. I am buying Apple because its integrated ecosystem of hardware, software, and services creates an incredibly sticky network effect and powerful brand loyalty, which allows them to consistently sell products at high margins and capture a disproportionate share of industry profits. This is a strong first sentence. It identifies the moat, the ecosystem, the mechanism, stickiness and brand loyalty, and the business outcome, high margins and profit share. Sentence 2. I believe the market is currently undervaluing this ecosystem's durability due to fears of smartphone commoditization and competition from Android, and I expect the continued growth of their high-margin services division to drive double-digit earnings growth over the next 5 years. This completes the thesis. It identifies the market's mispricing, fear of commoditization, and sets a specific, measurable expectation, double-digit earnings growth from services, over a defined time frame, 5 years. This two-sentence statement is now your North Star for this investment. It provides the ultimate clarity in investing. Every piece of news you hear about Apple can be filtered through it. Did they announce a new service that strengthens the ecosystem? That reinforces the thesis. Is a competitor's new phone getting great reviews? You can calmly assess if it truly threatens the stickiness of Apple's ecosystem, rather than panic selling. This framework is not easy. It requires real thought and research. But the process of forcing your analysis into this tight structure is where the magic happens. It squeezes out all the ambiguity, all the vague hopes, and leaves you with only the hard, clear core of your argument. It is the ultimate tool for achieving investor discipline and ensuring that you are always investing with a clear and simple purpose. The antithesis of this approach, the path of the 99%, is to fall for the allure of the 50-page analyst report. This is the world of manufactured complexity, where the illusion of precision is used to mask a lack of genuine insight. It is a world that caters to our cognitive biases, making us feel smart and sophisticated while subtly robbing us of our critical thinking. Imagine you are a typical investor and you receive a research report from a prestigious Wall Street investment bank. The report is 50 pages long, bound in a glossy cover with the bank's imposing logo. It is titled something like Initiating Coverage on Omnicorp, a Paradigm Shift in Synergistic Logistics. The report is dense with industry jargon. Our proprietary multi-factor model indicates a 35% upside, driven by catalysts including the optimization of their reverse logistics supply chain and the accretive impact of their recent bolt-on acquisition. It contains dozens of colorful charts, complex tables of financial projections calculated to 2 decimal points 5 years into the future, and a detailed discounted cash flow analysis with a specified weighted average cost of capital and terminal growth rate. As you read it, your eyes start to glaze over. You don't know what half of the terms mean. The sheer volume of information is overwhelming. But a powerful psychological effect is taking place. You assume that the people who wrote this must be geniuses. The complexity feels like a sign of authority and deep intelligence. You think to yourself, I could never do this kind of analysis. These guys clearly know what they're doing. You defer to their expertise. You don't adopt their thesis. You borrow it. You buy the stock, not because you understand the business, but because a 50-page report from a big-name bank told you to. This entire process is an exercise in intellectual intimidation. The complexity is often a feature, not a bug. It creates a moat of expertise around the financial industry, making individuals feel that they are unqualified to manage their own money. It convinces them to pay high fees for products and advice they don't understand. But if you were to apply the Feynman technique to most of these reports, they would crumble into dust. If you forced the analyst to explain their thesis to a child, you would often find that behind the 50 pages of jargon lies an incredibly weak or simple-minded core idea, such as, we think this company will sell more stuff next year. Dressed up in the language of quantitative rigor, the complex financial models are a classic example of what is often called physics envy. Finance professionals, wanting to emulate the precision of hard sciences like physics, build models that give the appearance of scientific accuracy. But unlike physics, which is governed by immutable laws, the business world is a complex, adaptive system driven by human emotion and unpredictable events. A DCF model that projects cash flows to the penny a decade from now is not a scientific instrument. It is an exercise in garbage in, garbage out. The precision is an illusion. Warren Buffett has famously joked, "It's better to be vaguely right than precisely wrong." The 50-page analyst report is often precisely wrong. It focuses on decimal points and forgets the big picture. The path of the 99% is to be impressed by this false precision. It is to believe that complexity equals sophistication. The path of the master investor is to be skeptical of it, to demand simplicity, and to recognize that true insight is not found in a 50-page report, but in a 2-sentence thesis that captures a profound and simple business truth. The direct financial connection between a simple, clear thesis and your long-term wealth is found in one of the most important concepts in all of value investing, the margin of safety. The margin of safety is the difference between the intrinsic value of a business and the price you pay for it in the market. A simple, articulable thesis is the bedrock upon which any credible calculation of intrinsic value is built. If your thesis is a tangled mess of 50 different variables and complex assumptions, your calculation of intrinsic value will be equally fragile. It becomes a house of cards. If any one of your dozens of assumptions proves to be wrong, the entire valuation collapses. Your margin of safety is an illusion based on a foundation of sand. Conversely, a simple thesis based on a single, powerful, durable competitive advantage allows for a much more robust and conservative estimation of intrinsic value. Let's return to the See's Candies example. The thesis was simple. A powerful brand creates durable pricing power. This simplicity allows for a very straightforward valuation. You can look back at 20 years of history and see that the company has consistently raised prices by 5 to 10% a year without losing customers. This gives you a high degree of confidence in projecting future cash flows. You can build your valuation on a single, powerful, and historically proven variable, the ability to raise prices. Your intrinsic value calculation is now built on a foundation of granite. Let's quantify this. Imagine 2 companies, Company A, Complex Co., and Company B, Simple Co. Company A is a technology conglomerate. Your thesis for it is complex. It relies on synergies between 5 different divisions: the success of a new R&D project, growth in emerging markets, and favorable regulatory changes. You build a detailed model and calculate an intrinsic value of $150 per share. The stock is trading at $100. It seems you have a $50 margin of safety. Company B is a dominant waste management company in a specific region. Your thesis is simple. It has a near monopoly on landfills, a durable asset that is almost impossible to replicate, which gives it predictable pricing power. Based on this simple reality, you conservatively estimate its intrinsic value at $120 per share. It is also trading at $100, giving you a smaller $20 margin of safety. Now a recession hits. For Complex Co., everything goes wrong. The synergies fail to materialize, the R&D project is delayed, and emerging markets slow down. Your valuation model shatters. The true intrinsic value was far lower than you thought, perhaps only $80. The stock collapses to $60, and you lose 40% of your investment. For Simple Co., the recession has a minimal impact. People still produce trash. The company is able to raise its prices slightly to cover inflation. Your simple thesis holds true. The intrinsic value remains stable around $120. The stock might dip to $90 in the market panic, but your margin of safety protected you from a permanent loss of capital. In fact, because your simple thesis is still intact, you can confidently buy more at the lower price. This is the financial power of a simple thesis. It doesn't just help you find good companies, it helps you build a resilient portfolio. It allows you to create a real, durable margin of safety, not a pseudoscientific one based on a spreadsheet. By forcing yourself to distill your reasoning into a simple, powerful statement, you are not dumbing down your analysis, you are stress testing it. You are ensuring that your financial security rests on a single, mighty pillar of truth, rather than a fragile web of hopeful assumptions. This is how clarity of thought translates directly into long-term, sustainable wealth. The third pillar of investing simplicity is perhaps the most critical for your long-term survival and success. Simplicity acts as a cognitive shield, a powerful defense mechanism against the destructive forces of emotional contagion that sweep through financial markets. When you have a simple, deeply understood, and clearly articulated investment thesis, you possess an anchor in the midst of a hurricane. This anchor doesn't stop the storm of volatility, but it prevents your portfolio from being smashed to pieces on the rocks of fear and panic. The most powerful story of Buffett using simplicity as a shield took place in the fall of 1963. It was a moment of absolute crisis for one of America's most respected companies, American Express. The salad oil scandal had just broken. A major client of American Express's warehousing division, the Allied Crude Vegetable Oil Refining Company, had perpetrated a massive fraud. They had secured huge loans using barrels of salad oil as collateral, but the barrels were mostly filled with seawater, with only a thin layer of oil on top. When the fraud was discovered, Allied Crude defaulted on its loans, and it appeared that American Express, which had guaranteed the safety of the collateral, was on the hook for losses that were larger than the company's entire net worth. The market panicked. Wall Street assumed American Express was insolvent. The stock collapsed, losing over 50% of its value in a matter of weeks. It was a classic, blood in the streets moment. The narrative was one of utter ruin. But Warren Buffett, then a young, relatively unknown money manager, didn't panic. He applied the rule of simplicity. He asked himself a simple question: does this warehousing scandal affect the core businesses of American Express? He knew that the company had two main profit centers: its travelers' checks and its credit card business. The investment thesis for American Express was simple. It had a powerful brand that equated to trust, which allowed it to dominate the travelers' check market and the burgeoning credit card industry. The question was whether the scandal had damaged that trust. Instead of reading the panicked Wall Street reports or listening to the screaming television pundits, Buffett did his own simple, on-the-ground research. He went out to restaurants and stores. He talked to the cashiers and owners, asking them if they were still accepting American Express cards and checks. They all said yes. He visited banks and spoke to loan officers, asking if they were still seeing strong demand for travelers' checks. They were. He observed human behavior. His simple investigation revealed a profound truth. The average consumer and merchant either didn't know about the salad oil scandal or didn't care. To them, the name American Express still meant financial security. The brand, the true source of the company's value, was completely unharmed. His simple thesis was still intact. The market, in its panic, was confusing a problem in a small, non-core division with the health of the entire enterprise. It was a classic case of emotional overreaction. With this simple, powerful insight, Buffett acted with incredible conviction. He invested 40% of his investment partnership's entire capital into American Express stock. It was a massive, concentrated bet. To outsiders, it looked like an act of insane recklessness. To Buffett, armed with the shield of a simple, verified thesis, it was the safest and most logical decision in the world. Of course he was right. As the panic subsided and the market realized the core business was sound, the stock soared. Buffett made a fortune for his partners, a return of more than 50% in 2 years. This story is the ultimate testament to the power of simplicity as an emotional fortress. The complexity of the scandal, the legal arguments, the accounting write-downs, all of this was noise. The simple central truth was that the brand was fine. By focusing only on that simple thesis, Buffett was immune to the terror that gripped the rest of the market. He was able to think rationally while everyone else was thinking emotionally, and that is the source of all great investment fortunes. The underlying psychological principle that makes a simple thesis such a potent shield is its ability to counteract one of the most powerful and destructive biases hardwired into the human brain: loss aversion. Coined by psychologists Daniel Kahneman and Amos Tversky, loss aversion describes our tendency to feel the pain of a loss approximately twice as strongly as we feel the pleasure of an equivalent gain. Losing $100 feels as bad as gaining $200 feels good. This asymmetry has profound implications for investor behavior. When a stock you own starts to fall, loss aversion kicks in with overwhelming force. The emotional pain is intense. Your brain's ancient, primal fear centers are activated. This triggers the fight-or-flight response. In the context of the stock market, flight means selling. Your brain screams at you, "Get out! Stop the pain! Sell now before it goes to zero." If your reason for owning the stock is weak, complex, or borrowed from someone else, you have no defense against this emotional onslaught. Your rational mind has no anchor, no counter-argument to the primal fear. You don't truly understand why you own the stock, so when it goes down, your only thought is that you made a mistake and need to correct it immediately. This is what leads to the cardinal sin of investing: buying high out of greed and selling low out of fear. A simple, deeply understood investment thesis acts as a cognitive anchor, a pre-commitment to rational thought. It is the story your rational brain tells itself to override the fear signals coming from your amygdala. When a stock you own drops 20% and the pain of loss aversion begins to set in, your anchor holds you steady. Instead of panicking, you can calmly pull out your one-page memo. You reread your 2-sentence thesis. Then you ask a simple, rational question: has the reason I bought this stock been fundamentally broken? Let's go back to the American Express example. Buffett's thesis was the brand is intact. When the stock collapsed, he didn't ask, why is the stock going down? He asked, is the brand still intact? His research confirmed that it was. Therefore, the falling stock price was not a signal of his own error, but a signal of the market's error. The drop in price wasn't a threat. It was an opportunity. This is a complete inversion of the normal emotional response. For the investor without a clear thesis, a falling price is a source of terror. For the investor with a clear thesis, a falling price, in the absence of a change in the underlying business reality, is a gift. The simple thesis acts as a switch, turning off the emotional, fear-driven part of your brain and turning on the analytical, opportunistic part. It provides the emotional control necessary for long-term investing success. Without this anchor, you are destined to be a victim of your own primal psychology, forever buying and selling at the worst possible times, driven by the twin emotions of greed and fear. With it, you can navigate the storms of the market with a calm and profitable detachment. To operationalize this principle and build your own emotional shield, you need a specific mental model, a practical exercise to perform before you ever commit capital. This tool is called the pre-mortem analysis. A post-mortem, which is common in medicine and engineering, is an analysis of what went wrong after a failure has already occurred. A pre-mortem is the opposite. It is a prospective exercise in which you imagine that your decision has already failed, and you work backward to figure out why. It is a powerful technique for identifying weaknesses in your plan before they become costly realities. Here is the blueprint for conducting an investment pre-mortem. Step 1. Before you buy a single share of a company, you must first write down your simple two-sentence investment thesis. This forces you to clarify your reasoning. Let's use our previous Apple example. I am buying Apple because its ecosystem creates a sticky network effect, allowing for high margins. The market is undervaluing this durability due to fears of smartphone commoditization. Step 2. You gather your investment committee, which might just be you and a notepad, and you begin the pre-mortem. You start with this statement. It is 1 year from today, and our investment in Apple has been a complete disaster. The stock is down 50%, and we have suffered a significant loss of capital. What went wrong? Step 3. Now, your job is to generate as many plausible reasons as you can for this hypothetical failure. This isn't a time for optimism. It's a time for creative pessimism. You must rigorously attack your own thesis. For the Apple thesis, the reasons for failure might include: a major antitrust lawsuit forces Apple to open up its App Store, destroying its high-margin services revenue. A competitor like Samsung finally creates a phone so compelling and innovative that it causes a mass exodus of users from the Apple ecosystem. A geopolitical event, perhaps related to China, severely disrupts Apple's supply chain and its access to the Chinese market. New privacy regulations make the data-driven advantages of the ecosystem less valuable. You write down every conceivable reason why your simple thesis might prove to be wrong. You are identifying the key points of failure, the load-bearing walls in your investment argument. Step 4. You review this list of potential disasters. This process does two critical things. First, it may convince you not to make the investment at all. You might realize that your thesis is far more fragile than you initially thought. This is a successful outcome, as it saves you from a future loss. Second, and more importantly, it prepares you for future volatility. You now have a checklist. If you make the investment and the stock begins to fall, you don't have to panic. You can pull out your pre-mortem list and calmly assess the situation. Is the stock falling because one of your predicted disaster scenarios is actually happening? If an antitrust lawsuit has been filed, then your thesis may indeed be broken, and it might be rational to sell. But what if the stock is falling simply because the entire market is in a correction, or because of a missed quarterly earnings estimate? You can look at your list and see that none of the fundamental pillars of your thesis have been damaged. The ecosystem is still sticky. The brand is still strong. This gives you the emotional fortitude not only to hold your position, but perhaps even to buy more at the lower price. The pre-mortem analysis is the ultimate tool for forging investor discipline. It formalizes the process of critical self-examination. It helps you distinguish between a genuine threat to your investment and the meaningless noise of the market. It turns you from a reactive, emotional gambler into a proactive, prepared strategist. The path of the 99% is a journey paved with a single, destructive thought that inevitably arises when an investment goes wrong. The market knows something I don't. This thought is the death knell of conviction. It is the natural byproduct of having a weak, borrowed, or non-existent investment thesis, and it is the primary driver of panic selling. Let's paint a picture of the average investor. They've bought a stock, let's call it Innovate Corp, based on a combination of a positive news article and a general feeling that its industry is, quote, the future. They don't have a simple, codified thesis. Their understanding of the business is superficial. For a few months, everything is great. The stock drifts upward, confirming their decision. Then, one morning, they wake up to see the stock is down 20% on no apparent news. Their first reaction is not analysis but a jolt of pure fear. Their mind starts racing. What's going on? Why is it falling so much? They frantically search for news, but find nothing significant. This is when the toxic thought creeps in. Someone must know something. The big institutional investors, the insiders, they're selling for a reason. They have information I don't have. I'm the sucker at the poker table. This feeling of being the dumb money is psychologically devastating. It creates a sense of powerlessness. They see the stock price, this objective number blinking in red, as the verdict of a vast omniscient entity called the market. They believe this entity has processed all available information and has declared that Innovate Corp is worth 20% less than it was yesterday. Who are they to argue with this collective wisdom? Their lack of a foundational thesis means they have no intellectual ground to stand on. They cannot say, the market is wrong because my analysis shows X, Y, and Z are still true. All they can say is, the market is probably right, and I am probably wrong. This is the moment of capitulation. They place the sell order, not because their analysis has changed, but because their emotions have overwhelmed them. They sell to make the pain stop and to align themselves with what they perceive to be the superior knowledge of the crowd. The 2008 financial crisis was the ultimate macro example of this phenomenon. As the market was collapsing, millions of people sold their holdings in fantastic companies like Johnson & Johnson or Procter & Gamble at absurdly low prices. Their thesis for owning these stocks was likely weak to begin with, probably something vague like, it's a good blue-chip stock. When the storm hit, that flimsy thesis was washed away instantly. They looked at the sea of red and thought, the whole system is collapsing. The experts on TV are terrified. The market knows this is the end. They sold out of sheer terror. An investor who had a simple thesis for owning Johnson & Johnson. They sell essential healthcare products that people need regardless of the economy, generating stable cash flow, could have looked at the chaos and thought, does the financial crisis mean people will stop buying Band-Aids or Tylenol? No. My thesis is intact. The market is giving me the gift of a lifetime. The thought the market knows something I don't is the refuge of the intellectually unprepared. By insisting on a simple, deeply understood thesis, you are declaring that you will rely on your own judgment. You are stating that you will not be a passive victim of the market's manic-depressive mood swings. You will be an active analyst of business reality, and you will have the courage to believe that sometimes, just sometimes, the market is a fool. The direct financial consequence of succumbing to emotional panic versus maintaining discipline through a simple thesis can be quantified by a concept known as the volatility tax. This isn't a tax levied by the government, it is a tax you impose on yourself through bad behavior. It represents the gap between an investment's reported long-term return and the actual return the average investor in that investment achieves. The difference is often staggering, and it is almost entirely attributable to emotionally driven selling and buying at the wrong times. Let's illustrate this with a clear, numerical example. Consider a high-quality stock, SimpleCo, that over a 20-year period delivers a compounded annual return of 10%. An initial investment of $100,000 left untouched would grow to approximately $672,750. This is the buy and hold or investment return. Now let's look at the journey of two investors. Investor A has a simple, strong thesis for owning SimpleCo. They understand the business and are prepared for volatility. Over the 20 years, the market experiences two major bear markets. In the first one, the stock drops 40%. In the second, it drops 30%. Because Investor A's thesis remains intact, they do not sell. They hold on through the downturns and may even add to their position. At the end of 20 years, their account balance is $672,750. They have captured the full investment return. Investor B owns the same stock, but has no real thesis. They bought it because it was going up. When the first bear market hits and the stock drops 40%, from $100,000 down to $60,000, they panic. Loss aversion kicks in, and they sell everything at the bottom to stop the bleeding. The market eventually recovers, and after the stock has already rallied significantly, Investor B feels the fear of missing out and buys back in. Let's say they get back in when their original capital would have been worth $120,000, but they only have $60,000 to reinvest. They have paid a massive volatility tax. They repeat this behavior during the second bear market. The financial services analytics firm Dalbar has studied this phenomenon for decades. Their research consistently shows that the average equity fund investor earns a return that is significantly lower than the return of the very fund they are invested in. Over a 20-year period, this gap can amount to several percentage points per year. A 2% annual underperformance due to bad timing doesn't sound like much, but over a long period, it is financially devastating. If our investor B's panic-driven behavior caused them to earn just 7% per year instead of the stock's 10% return, their final portfolio value would be only $386,968. That is $285,782 less than investor A. This difference, nearly $300,000, is the volatility tax. It is the direct, quantifiable financial cost of investing, without a clear, simple thesis to anchor your emotions. A simple thesis is, therefore, not just a tool for better decision-making. It is a literal, wealth preservation machine. It is the psychological armor that protects your capital from your own worst instincts, ensuring that you are the one who gets to keep the powerful rewards of long-term compounding, rather than donating them to the market in a fit of panic. As we delve deeper into this philosophy, we must confront a dangerous and seductive force that constantly pulls investors away from the path of simplicity, the deception of complexity. Human beings have a deep-seated tendency to equate complexity with sophistication and intelligence. We are naturally drawn to ideas, strategies, and people that seem intricate and difficult to understand, assuming they must be superior. This cognitive bias is a trap, one that has been sprung on even the most brilliant minds, leading to some of the most spectacular blow-ups in financial history. The ultimate cautionary tale, a story that should be etched into the mind of every investor, is the rise and catastrophic fall of a hedge fund called long-term capital management, or LTCM. If ever there was a firm built on the worship of complexity, this was it. Founded in 1994, LTCM was a dream team of financial and intellectual firepower. Its partners included John Meriwether, the legendary former head of bond trading at Salomon Brothers, and, most notably, two Nobel Prize-winning economists, Myron Scholes and Robert C. Merton. These were the men who had literally written the book on derivatives pricing, developing the Black-Scholes model, a cornerstone of modern financial theory. Their strategy was the epitome of complexity. They engaged in highly leveraged arbitrage strategies, making thousands of bets in global markets, designed to profit from tiny temporary discrepancies in the prices of related securities. They built incredibly sophisticated computer models, rooted in academic theory and historical data, which they believed could predict and exploit market behavior with near scientific certainty. Their models were so complex that even most of their own investors didn't fully understand them. But that was part of the allure. The firm's pedigree was impeccable. Its methods were impenetrably complex, and for a few years, its returns were astronomical. They generated returns of over 40% annually, with seemingly no risk. The elite of the financial world clamored to invest, believing they had found the Holy Grail, a money machine run by geniuses who had tamed the volatile beast of the market. Warren Buffett was, of course, approached to invest. His response was simple and unwavering. He looked at their strategy, listened to their pitch, and declined. His reasoning was the same as it was during the dot-com bubble. He didn't understand it. He couldn't, in simple terms, explain how they were making money. He saw models built on historical data and academic assumptions, but he knew that the real world was messy and unpredictable. He knew that human fear and greed could shatter the elegant equations of Nobel laureates. As he later said, quote, "To make money they didn't have and didn't need, they risked what they did have and did need. That is foolish." While the geniuses at LTCM were building their complex tower of financial engineering, Buffett was sticking to simple businesses like Coca-Cola and Gillette. In August 1998, the tower came crashing down. A confluence of unforeseen events, Russia defaulting on its debt and a global flight to safety, caused the market discrepancies LTCM was betting on to widen dramatically instead of converging. Their models, which had assumed a normal bell curve distribution of events, failed to account for a black swan event. Because they were so highly leveraged, their losses were catastrophic. In a matter of weeks, the fund lost over $4.6 billion and was on the brink of collapse. Its failure was so systemic that it threatened to take down the entire global financial system, forcing the Federal Reserve to orchestrate a massive bailout from a consortium of Wall Street banks. The geniuses had failed. Their complexity had not been a shield against risk, it had been a magnifying glass for it. They had built a system so intricate and so tightly coupled that a single, unforeseen failure could cause the entire structure to implode. The story of LTCM is a stark and terrifying lesson. It demonstrates that intellectual firepower and complexity are no match for the simple, brutal realities of market fear and unforeseen events. Buffett's simple rule, "If you can't explain it, don't do it," was once again proven to be not a sign of intellectual weakness, but the highest form of financial wisdom. The psychological trap that ensnared the investors and partners of LTCM is rooted in two powerful cognitive biases: authority bias and the halo effect. These mental shortcuts, while often useful in navigating a complex world, can be financially fatal when misapplied. Authority bias is our tendency to attribute greater accuracy and importance to the opinion of an authority figure. From a young age, we are taught to listen to and respect experts, parents, teachers, doctors. This is generally a good survival strategy. However, in fields like finance, where the future is fundamentally unknowable, our deference to authority can lead us astray. When a man with a Nobel Prize in economics tells you he has invented a risk-free way to make money, your brain is wired to believe him. The Nobel Prize winner title acts as a stamp of unquestionable authority. It short-circuits our critical thinking. We stop questioning the substance of the argument and instead accept it based on the credentials of the person making it. We think, "He's a genius, he must be right," rather than, "Let me see if I can understand this idea for myself." This is precisely what happened with LTCM. Investors handed over their money not because they understood the arcane arbitrage strategies, but because they trusted the authority of the Nobel laureates. The halo effect is a related bias where our positive impression of a person, company, or brand in one area positively influences our feelings in another area. If someone is brilliant at one thing, like developing options pricing models, we tend to assume they are brilliant at everything, like managing real-world risk. The halo of their Nobel Prize extended to their perceived ability as money managers. The impenetrable complexity of their strategy actually enhanced this effect. The jargon, stochastic volatility models, convergence trades, acted as a signal of exclusivity and intelligence. It made investors feel like they were part of a special, elite club. To question the strategy or admit you didn't understand it would be to reveal yourself as unsophisticated. It was easier and more comfortable for the ego to simply nod along and trust the experts. The financial industry masterfully exploits these biases. They fill their marketing materials with the credentials of their PhD-laden quant teams. They create products with complex names and convoluted strategies, knowing that this will intimidate and impress the average investor. The complexity is not designed for better returns. It is designed to justify high fees and create an aura of expertise that discourages scrutiny. The antidote to these biases is a conscious and deliberate dose of skepticism, embodied in the principle of simplicity. By making it a personal rule, that you will not invest in anything you cannot explain yourself, you are breaking the spell of authority. You are reclaiming your intellectual sovereignty. You are stating that no credential, no matter how prestigious, is a substitute for your own understanding. You force the argument to stand on its own merits, stripped of the halo of its source. This is not about disrespecting expertise. It is about refusing to be a passive recipient of it. It is the commitment to being the final arbiter of your own financial decisions. To protect yourself from the seductive allure of complexity, you need a simple, practical filter that can be applied to any investment or business decision. This mental model is the "explain it to a fifth grader" test. It is a direct application of the Feynman technique, designed to be a quick, powerful, and humbling check on your own understanding. The rule is simple. Before you make any significant financial commitment, you must be able to explain the core idea to an imaginary 10-year-old. This explanation must be done using simple words, relatable analogies, and absolutely no industry jargon. If you cannot do it, you do not understand the idea well enough to risk your money on it. Let's see how this works in practice. Imagine you are considering an investment in a, quote, quantitatively driven, multi-strategy market-neutral hedge fund. Try to explain that to a fifth grader. You would quickly find yourself sputtering, "Well, they use, complex computer algorithms to find market inefficiencies. It's impossible." The test reveals that the strategy is a black box, and you would simply be handing your money over on blind faith. Now let's try the test on a classic Buffett investment, the Burlington Northern Santa Fe Railroad. Imagine you have a giant toy train set that runs all across the country. This train carries all the important things people need, like the food you eat, the coal that makes electricity, and the new cars that show up at the dealership. Because it would be so expensive for anyone else to build another giant train set right next to yours, you are the only one who can carry things this way. So everyone has to pay you a little bit of money to use your train, and because you own the only train set, you can charge a fair price and make money for a very, very long time. A fifth grader would understand that. The test reveals a simple, powerful, and durable business model. It's crucial to understand that this test is not about making simplistic investments. It is about achieving a profound level of understanding that makes simplification possible. Albert Einstein famously said, "If you can't explain it simply, you don't understand it well enough." The goal is not to avoid difficult subjects, but to master them to the point where their essential truth can be extracted and communicated clearly. This test is a powerful defense against intellectual dishonesty, both from others and from yourself. It stops you from fooling yourself into thinking you understand something just because you can repeat the jargon associated with it. When a financial advisor is pitching you a complex insurance product or structured note, ask them to explain it to you as if you were a fifth grader. Watch what happens. Often they will be unable to do it, revealing that they may not fully understand the product they are selling. The "explain it to a fifth grader" test is your personal lie detector for complexity. It is the ultimate tool for enforcing clarity of thought and ensuring that your capital is only ever deployed in service of ideas that are robust, understandable, and fundamentally simple. The antithesis to this philosophy of simplicity is the path followed by the vast majority of market participants, the seductive allure of sophisticated strategies. This is the world of high-turnover trading, complex derivatives, leveraged financial products, and chasing the bleeding edge of technology. People are drawn to these strategies not because they are demonstrably better, but because they satisfy a deep-seated psychological need to feel intelligent, exclusive, and in the know. It is a massive ego trap, and it is one of the most efficient ways to transfer wealth from your pocket to Wall Street's. Consider the day trader, who sits in front of 6 monitors, watching blinking charts and using technical analysis indicators like the Relative Strength Index or MACD crossovers. They believe they are engaging in a sophisticated form of market analysis, deciphering secret patterns in the squiggles on a screen. The reality, as decades of academic research has shown, is that the vast majority of day traders lose money. They are not investing. They are gambling on random price movements, all while paying a steady stream of commissions and fees. Or think of the investor who gets hooked on complex options trading. They learn the jargon, iron condors, straddles, gamma scalping, and they feel like they are part of an elite group with access to secret money-making tools. While options can be useful for hedging, using them speculatively is a zero-sum game with a negative slant due to transaction costs. For every trader who wins, another loses. The only guaranteed winner is the brokerage firm collecting the commissions. Then there are the leveraged ETFs, products that promise to deliver 2 or 3 times the daily return of an index. These sound incredibly sophisticated and powerful. But they are plagued by a mathematical certainty called beta slippage, or volatility decay, which means that over any extended period of time, especially in a volatile market, their returns will be significantly lower than their stated multiple. They are complex products designed for very short-term professional hedging, yet they are marketed to retail investors as a way to turbocharge their returns, often with disastrous results. The allure of these strategies is about ego. It feels better to tell your friends you are selling puts on a high-beta tech stock than it does to say, "I am buying and holding an index fund," or "I own a company that collects trash." The simple path feels boring and unsophisticated. The complex path feels exciting and intelligent. This is the great deception. The simple path, followed with discipline, is the one that leads to sustainable wealth. The complex path, for the vast majority of people, leads to high costs, high stress, and poor returns. It is a game where the complexity itself is the product, designed to make you feel smart while the house takes its cut. The truly sophisticated investor understands this. They know that the ultimate sophistication is to ignore the noise, bypass the complexity, and focus on the simple, powerful, and enduring principles of business ownership. Perhaps the most direct and devastating financial consequence of embracing complexity is the tyranny of fees. There is an almost perfect correlation in the financial world. The more complex a product is, the higher the fees it charges. These fees, which often seem small on an annual basis, compound over an investing lifetime and can consume a truly shocking portion of your potential wealth. This is where the battle between simplicity and complexity hits your bank account with the force of a tidal wave. Let's compare 2 scenarios. Scenario A is the path of simplicity. You invest in a simple, low-cost S&P 500 index fund. This fund simply buys and holds the 500 largest companies in the U.S. There is no complex strategy. The annual expense ratio for such a fund is incredibly low, perhaps 0.04%. This means for every $10,000 you have invested, you pay just $4 per year in fees. Scenario B is the path of complexity. You invest in a sophisticated hedge fund or a complex actively managed mutual fund. The manager employs a proprietary strategy, engages in frequent trading, and uses derivatives. For this perceived expertise, they charge a typical 2 and 20 inches fee structure, a 2% annual management fee on all assets, plus 20% of any profits, or a high mutual fund expense ratio of, say, 1.5%. Let's assume both the underlying market and the complex fund generate a gross return of 10% per year before fees. We'll start with a $100,000 investment and look at the results over 30 years. Investor A, in the simple index fund, pays a 0.04% fee. Their net annual return is 9.96%. After 30 years, their initial $100,000 grows to approximately $1,728,000. Investor B in the complex fund pays a 1.5% annual fee. Their net annual return is 8.5%. After 30 years, their initial $100,000 grows to approximately $1,155,000. The difference is staggering. The tyranny of what seemed like a small annual fee has cost investor B over $573,000. That is more than half of their initial investment, vaporized into the pockets of the fund manager, not because of poor performance, but simply because of the high cost of complexity. The hedge fund 2 and 20 inches structure is even more destructive. That 2% annual fee is a constant drag, and the 20% performance fee means you are taking 100% of the risk, while the manager gets to keep a huge slice of any potential upside. Over time, this fee structure makes it mathematically heroic for an investor to outperform a simple, low-cost index fund. Warren Buffett has spoken about this relentlessly. He famously made a 10-year bet that a simple, unmanaged S&P 500 index fund would outperform a portfolio of actively managed hedge funds after fees. He won the bet in a landslide. It wasn't even close. The lesson is brutally simple. Fees are a direct and relentless tax on your returns. Complexity is the primary justification for high fees. Therefore, by embracing simplicity, you are not just adopting a clearer way of thinking, you are making a conscious decision to keep more of your own money. You are opting out of a system designed to enrich Wall Street and opting into a system designed to enrich you. Every basis point you save in fees is a basis point that gets to compound for you, not for someone else. Over an investing lifetime, this single decision can be the difference between a comfortable retirement and generational wealth. We arrive now at the final and most powerful pillar of this philosophy, the recognition that simplicity itself is a source of immense compounding power. Simple, understandable businesses are not just easier to analyze, they often possess the most durable and long-lasting competitive advantages. By focusing on simplicity, you align your portfolio with the most potent force in the financial universe, the slow, steady, and relentless magic of compounding. There is no story that encapsulates this principle more perfectly than Warren Buffett's single greatest investment, his 1988 purchase of a massive stake in the Coca-Cola Company. In the late 1980s, the market was still reeling from the crash of 1987. Fear and uncertainty were rampant, but Buffett wasn't looking at the market's daily gyrations. He was looking for a simple, predictable, and wonderful business. He found it in Coca-Cola. His investment thesis was so simple it could have been written on a cocktail napkin, and in fact, it often was. It went something like this. Coca-Cola sells a non-alcoholic beverage that is cheap, refreshing, and creates a positive association in the customer's mind. The brand is one of the most powerful and recognized on the entire planet. The product has a global distribution network that would be almost impossible for a competitor to replicate. A person in virtually any country on Earth can have a Coke. Because the product costs so little to produce, the business has enormous profit margins. And most importantly, the product is timeless. People were enjoying Coca-Cola 50 years ago, they are enjoying it today, and they will likely be enjoying it 50 years from now. It is a simple, beautiful economic machine. That was it. No complex models. No intricate forecasts about technological change. Just a simple insight into a simple business with a simple, durable, competitive advantage. Based on this thesis, over 1988 and 1989, Berkshire Hathaway invested over $1 billion to acquire a significant stake in the company. At the time, it was a huge bet. Many on Wall Street were skeptical, viewing Coca-Cola as a mature, slow-growth company. They were focused on more complex and exciting stories. But Buffett saw the compounding power of that simplicity. He saw a business that would gush cash year after year, a company that could consistently raise its prices, and a brand that would continue to deepen its connection with consumers worldwide. He bought the stock and then, for the most part, he did nothing. He let the simple power of the business do the work. The result was one of the most successful investments in history. That $1 billion investment has since paid Berkshire billions upon billions of dollars in dividends alone. And the value of the shares themselves has grown exponentially. Held with conviction for decades, that one simple idea, the idea of selling sugar water to a thirsty world, compounded into a position worth well over $20 billion. It became a cornerstone of Berkshire's wealth. The story of Coca-Cola is the ultimate lesson in simplicity's compounding power. The most extraordinary long-term returns often come from the most ordinary, understandable businesses. The magic is not in finding a complex secret, but in recognizing a simple, enduring truth and having the patience and discipline to let it work for you over a very long time. The psychological reason why we so often miss these simple compounding machines lies in a fundamental flaw in our cognitive wiring. Our brains are not built to intuitively grasp the power of exponential growth. We think in linear terms. If you ask someone to predict the outcome of a process that grows by a fixed amount each year, they will be reasonably accurate. But if you ask them to predict the outcome of a process that grows by a percentage each year, the very definition of compounding, their estimates will be wildly off, especially over long time horizons. This is why the early years of a compounding journey feel so slow and unsatisfying. An investment that grows at 10% a year turns $10,000 into $11,000 in the first year, a gain of just $1,000. It's not very exciting, but in year 30, that same 10% growth adds over $158,000 in a single year. The curve sweeps upward with a force that our linear thinking minds find hard to believe. Simple, durable businesses are the perfect vehicles for this exponential force. Why? Because their predictability allows compounding to work its magic uninterrupted. A company with a complex, ever-changing business model is constantly at risk of disruption. It has to reinvent itself every few years, which means the compounding process is constantly being reset. A simple business like Coca-Cola selling beverages or Waste Management collecting trash has a business model that is likely to be the same in 20 years as it is today. This stability is the soil in which the oak tree of compounding can grow to its full potential. Furthermore, our minds are plagued by a myopic focus, a tendency to overemphasize short-term results at the expense of long-term outcomes. Wall Street is obsessed with quarterly earnings reports. The financial media breathlessly analyzes every minor beat or miss. This creates a blizzard of complexity and noise that distracts investors from the simple, long-term picture. By focusing on a simple investment thesis, you are consciously choosing to tune out this short-term noise. You are lifting your gaze from the next 3 months to the next 30 years. You are trading the fleeting excitement of short-term speculation for the profound, life-changing power of long-term compounding. Embracing simplicity is a psychological commitment to patience. It is the recognition that the greatest financial rewards do not go to the most active or the most brilliant, but to the most disciplined. It is about aligning your investment strategy with the mathematical certainty of exponential growth and having the wisdom to get out of its way. To harness this power in your own portfolio, you need a final mental model, a simple filter to ensure you are only buying the kinds of businesses that are built for long-term compounding. This is the 10-year test. It is a single, powerful question that you must ask yourself before you buy any stock. The question is this: can I, with a high degree of confidence, describe what this company's business will look like and how it will make money in 10 years? This test is a ruthless filter for durability and simplicity. Let's apply it to a few examples. A company like Wrigley's Gum, another one of Buffett's favorites. Can you describe its business in 10 years? Yes, it will be selling gum. The flavors might change, the packaging might be different, but the fundamental business of manufacturing and distributing chewing gum will be largely the same. It passes the test. How about a company like Waste Management? Can you describe its business in 10 years? Yes, it will be collecting trash from homes and businesses and putting it in landfills. The trucks might be electric, the logistics might be more efficient, but the core, simple business will remain. It passes the test. Now let's apply the test to a more complex, speculative company, a cutting-edge firm working on quantum computing. Can you describe its business in 10 years? It's almost impossible. Will their technology even be viable? Who will their main competitors be? What will their business model look like? Will they sell hardware, license software, or offer a cloud service? The range of possible outcomes is enormous. The level of uncertainty is massive. It fails the test. This doesn't mean the quantum computing company is a bad company. It might change the world. But for the purposes of long-term high-conviction investing, it is an unknowable entity. Investing in it is a speculation on a particular future. not an investment in a durable business. The 10-year test forces you to focus on businesses with understandable and enduring competitive advantages. It naturally biases your portfolio towards the simple, boring companies that are often the most powerful long-term compounders. It is a tool for achieving the financial freedom that comes from owning a collection of assets that work for you, steadily and predictably year after year. To execute the blueprint, before each purchase, write down your answer to the 10-year test. Don't just think it, write it. In 10 years, I believe Company X will be making money by. This written commitment forces clarity and serves as a record of your thinking. Over time, you will build a portfolio not of speculative bets, but of simple, durable, cash-generating machines, the true engines of long-term wealth creation. The path of the 99% is, once again, the polar opposite of this patient, long-term view. It is defined by the get-rich-quick mindset and a pattern of constant portfolio churn. The average investor is not thinking about the 10-year test, they are thinking about the next 10 days. Their goal is not to own a piece of a wonderful business for a lifetime. It is to catch a ride on a hot stock that they hope will double in 6 months. This mindset leads to a flurry of activity that is almost always counterproductive. They are constantly checking their brokerage account, reacting to every news headline, and jumping from one hot trend to the next. They buy a solar energy stock when it's in the news, sell it a few months later to buy a cannabis stock, then sell that to chase a cryptocurrency. They are always planting new seeds but never stick around long enough to let a mighty oak tree grow. This constant churn is financially ruinous for 3 key reasons. First, transaction costs. Every time you buy or sell a stock, you incur costs, whether they are explicit commissions or the more hidden cost of the bid-ask spread. These small costs add up over time and act as a steady drag on your performance. Second, taxes. When you hold an investment for more than a year, any gains are typically taxed at a lower, long-term capital gains rate. When you buy and sell in less than a year, your gains are taxed at your ordinary income tax rate, which is usually much higher. The get-rich-quick trader is essentially donating a huge portion of their winnings, if they have any, directly to the government. Third, and most importantly, it guarantees you will never benefit from the true power of long-term compounding. The real magic of an investment like Coca-Cola happened in years 10, 20, and 30. The churn-focused investor sells in month 6, capturing a tiny fraction of the potential gain and ensuring they miss out on the massive, exponential growth that comes later. Buffett has a wonderful phrase to describe his preferred level of activity: lethargy bordering on sloth. He understands that in investing, activity is often the enemy of returns. The real work is done upfront in the analysis, finding the simple, wonderful business. Once that work is done, the best course of action is often to do nothing at all for a very, very long time. The path of the 99% is a frantic, expensive, and ultimately futile sprint. The path of the master investor is a calm, patient, and profoundly profitable marathon. The ultimate financial connection, the culmination of this entire philosophy, is how a portfolio of simple businesses creates a self-sustaining engine of wealth through the unseen multiplier of reinvested earnings. A truly great simple business doesn't just grow, it produces excess cash that can be used to buy other great businesses, creating a compounding effect on top of a compounding effect. Let's trace the financial DNA of Berkshire Hathaway. It started with the cash flows from a struggling textile mill. That cash was used to buy an insurance company. The insurance company's float, the premiums collected that had not yet been paid out in claims, provided more cash. That cash was then used to buy See's Candies. See's Candies required very little capital to run and gushed cash every year. That cash from selling chocolates was then used to buy a massive stake in Coca-Cola. Coca-Cola's dividends and earnings provided even more cash, which was used to buy the Burlington Northern Railroad. And so on and so on. It is a virtuous cycle. Simplicity creates durable profits. Durable profits create excess cash. That excess cash, when reinvested wisely into other simple, profitable businesses, creates a snowball of capital that grows at an ever-accelerating rate. Let's quantify this with a final, powerful comparison. Investor A puts $100,000 into a portfolio of 10 speculative, complex story stocks. These companies are unprofitable and burn cash, but they have exciting narratives. After a decade, a few might be modest winners, but many will have gone to zero. Their portfolio is likely worth less than what they started with. Investor B puts $100,000 into a single, simple, profitable company, a mini Berkshire. Let's say this company earns a consistent 15% on its equity each year and retains all of its earnings to reinvest. In year 1, the $100,000 earns $15,000. The company is now worth $115,000. In year 2, it earns 15% on that new, higher base, a gain of $17,250. This is the simple magic of compounding. But the real multiplier is that the company's management is using that retained cash to buy other simple profitable assets. This isn't just a stock going up, it is an economic machine that is actively acquiring more and more cash-generating assets under its umbrella. After 30 years, assuming that 15% compounding rate holds, Investor B's initial $100,000 investment would be worth over $6.6 million. This is not a fantasy. This is the mathematical reality of what happens when you combine a simple, profitable business model with the disciplined reinvestment of capital over a long period. This is the ultimate financial advantage of simplicity. It isn't just about avoiding mistakes or sleeping well at night. It is about harnessing the most powerful, wealth-creating force on the planet. The compounding of capital within simple, durable, and understandable enterprises. This is the final promise of the rule of simplicity. Clarity of thought leads to quality of business, and quality of business, over time, leads to a quantity of wealth that the seeker of complexity can only dream of. You have just journeyed through the core of an investment philosophy that has created more wealth than perhaps any other in history. You now possess a powerful filter against financial catastrophe and confusion, the rule of radical simplicity. This is not just a tip or a tactic. It is a complete mental model for interacting with the world of money, a shield to protect you from the noise of the crowd and the destructive complexity that preys on ignorance. But this rule of simplicity is only the first line of defense in the Buffett-Munger system of thought. It's the gatekeeper. It tells you where to look and what to avoid. What happens once an idea passes this test? How do you then determine the precise price to pay to ensure a margin of safety? How do you build an entire portfolio of these simple, powerful ideas and manage it with the temperament of a master? That requires mastering the next piece of the puzzle, the next layer of this intellectual latticework. The video on your screen right now is that next piece. It is the link that connects what to buy with when to buy it. It takes the clarity you have just learned and weaponizes it with a framework for action, a system for valuation that allows you to act with courage when others are frozen with fear. Many will stop here, content with this one powerful idea. They will have improved their process, but they will not have completed their arsenal. But for those who are serious about building not just a portfolio, but a fortress of financial independence, the journey continues. The choice isn't about watching another video. It is about deciding if you are a dabbler or a master builder. Click and continue your ascent.